Hello, everyone. Welcome back. This is Dave Keller, Chief Market Strategist at StockCharts.com. Thanks again for joining us on the final bar. I want to welcome on my guest, Ryan Detrick from LPL Financial. Ryan, welcome to the show. Thanks so much for coming on.
Hey, Dave. Thank you very much for having me. I've listened to the show for a few weeks. I'm a big fan, and I'm honored you invited me today on what turned out to be the second most boring day of the year. S&P only in a 33 basis point move all day, so we'll come up with something to say, but my, oh my.
I promise we did not intentionally do that and try to make it a little lower, but we take what we can get, right? So I always coach our viewers to make sure that they have a proper long-term perspective. So I love some of the charts that you sent, trying to think about the presidential cycle. So can you talk us through the first chart here? Yeah,
Dave, I sure can. So, look at last year. Now, what we have here on the screen is the 4-year presidential cycle. I think the thing that's important to note, the dark green on the bottom is the max pullback per year. This goes back to 1950. And then the top green is the return a year later after those lows. So let's focus on the midterm year one, which was last year. Dave, the largest pullbacks take place during a midterm year. We had a 19.8% correction in the fourth quarter last year. The worst fourth quarter since the financial crisis. The first year since the Great Depression. December was the worst month of the year. I think the key thing at LPL Research that we try to note, big pullbacks for whatever reason happen in midterm years. The really good news, though, is what happens a year off those lows. And you can see a year off of the lows, you're up over 30%. Now, the lows we know were December 24th last year. The S&P as of the second is up 26% from those lows. What this chart says is, hey, maybe we could be up 30% by the time, or over 30% by the time Christmas Eve rolls around again. And there's lots of other things to look at, but it's so important to note this is a pre-election year. Been higher every single time since World War II on a total return basis. A year off those lows, you've been higher every single time since 1950. So sometimes the calendar plays in, and it's never that simple, but this is something that we looked at and said, man, are we really going to go into a recession? Are we really going to have a bear market this year? This chart is one we shared a year ago right now. It said no, and fortunately so far it's played out.
Very interesting. Your second chart was thinking about just corrections and how to process those. What do you see here?
That's right, Dave. We have at LPL over 16,000 advisors, and I'm the senior market strategist for them. And I like to point out the fact corrections happen. What we show here is just how many times you have a 5% correction per year. We just had our third 5% correction recently. So yes, this year feels volatile. All the headlines about trade and China and the drama out of Washington. Yet, here we are in the bullish fourth quarter. October is usually strong. I mean, think about this. This is a pre-election year in the month of October. Since 1987, October has only been down once during a pre-election year. So the bulls still are in our side here, we think, seasonality-wise. But looking at this screen here, we've had 5% corrections this year. That's normal. We've only had a 7% correction from peak to trough all year. That's actually abnormal. So this year might feel with the headlines really scary and frustrating, but my, oh my, S&P's up, nearly 20% for the year, and it's been relatively modest with just 5% corrections. It's really important to have that context, I think, when we talk about big picture views and how things are going.
It's funny, in the heat of a correction, when the market actually sells off, we that's when the emotions tend to come out. But this is such a great reminder of how often we have these sorts of movements. It's not abnormal, right? I mean, not having one is actually more abnormal than having a correction. That's a great slide.
All right.
The last one was addressing the president, and I cannot wait to hear your conclusions from this list.
Yeah, one of the most popular questions we obviously receive is about the election coming up in 13 months. And, we don't really have an opinion there, but here's something I think is really interesting that people should note. I took a look at when you have a recession. I know this is, we're talking technicals here. I know we're going to get a little fundamental here on this last one. When you have a recession within 2 years before the election, what tends to happen, the incumbent president tends to lose. If you don't have a recession, Dave, and you can see it here where it says no recession, the last 11 times we did not have a recession 2 years before the November election, the incumbent president won every single time. The time it didn't work was Calvin Coolidge back in 1924. If you have a recession 5 of the 7 times that incumbent president actually lost. So what did Carville say in 1992? He was Clinton's advisor. He said it's the economy, stupid, meaning the 1991 recession was in everyone's minds, and then President Clinton beat President Bush in the election. So this is just a big picture thing of, hey, if we're going to have a recession, that could be one thing. If we don't have a recession, maybe people are in a good mood. It could mean another. I'm Switzerland here. I'm not making any predictions. I'm just saying it's really interesting, what happens here. 11 out of 11 times, man, you don't have a recession, the incumbent wins. That's pretty powerful, I think.
And again, not to get too deep into some of this, but it strikes me, this reminds me a lot of Robert Prechter's work, thinking of socionomics and just, social mood and how people are thinking or feeling about the economy and their job and all of that. And then that compels them to take certain action, which you certainly seem to be, hinting at here with the table.
No, absolutely. I'm a big fan of that. And, you mentioned, Mr. Prechter, today is actually my 13th wedding anniversary. So we've hit a Fibonacci number today, Dave, 13. So, you think about the way everything's connected. Maybe this will be a good year for my wife, Emily, and I on our 13th anniversary. We're going to dinner tonight, but maybe a better year this year.
I certainly hope it's a great one, and happy anniversary, Ryan. Listen, thank you so much for coming on the show. These are 3 really good charts and a great reminder to everyone to sort of take a step back, remember these cycles and the corrective patterns and how they're all happening. I mean, don't get too caught up in the short-term noise that you forget to pay attention to the long-term. Ryan, thanks so much for coming on the show. Appreciate it.
Dave, I would be remiss if I didn't say OH.
IO, back at you.
Yeah, Buckeyes looking good. Thanks, man. Appreciate it.